What's up, everybody? Josh Bennett here with Money Masters. In this video, we're going to give you an understanding of taxes for beginners. So the tax code is obviously incredibly complex considering it's like 70,000 plus pages long and no one in their right mind has the time or energy to read all those. But as a United States citizen, assuming you're watching this in the United States, you're going to want to have a basic understanding of how the tax system works. One, so you can make sure you're not doing anything illegal, but also to just make sure by understanding your taxes, you can help control your tax bill and make sure you're not necessarily giving Uncle Sam more than your fair share. So in this video, again, we're going to take a look at how the tax system works and just give you a basic understanding of what to expect from taxes on an ongoing basis. And obviously taxes are going to change from year to year, but these are going to be the things that typically apply on a year-to-year basis. So hopefully this gives you a good overview, because I know a lot of people this isn't taught really in high school or at all. So this may be the first time you're learning any of this stuff. So again, I'm going to try and hold your hand through it. I know this is not the most exhilarating stuff in the world, so hopefully I keep it entertaining enough for you to stick around. So let's take a look here. So the first thing you need to understand is kind of how the tax system works in a nutshell, which is based on a marginal bracket system and an effective tax rate system. So these are two important factors for really understanding the tax code. And basically, in a nutshell, how the marginal tax system works is as you make more and more money, you're going to pay more and more tax in terms of percentage and also just pure dollar figures. So for example, as we see here, this is the 2020 tax bracket. So if you make $0 to $9,000 as a single person, then you're going to pay 10% on that income. If you are married filing jointly, so meaning you and a spouse, if you're married, you're going to pay 10% on $0 to $19,000 of income, which makes sense because you're basically just sort of doubling it, if that makes sense. So then if you make between $9,000 to $40,000, you're going to, on that $9,000 to $40,000, you step up to that next marginal tax bracket, meaning this amount of income is going to be taxed at 12%, not 10%, no matter what. So say you make $40,000, that first $10,000, give or take, is going to be at 10% no matter what. The next $30,000 is going to be at 12%. You start making more, then it goes up to 22, and you can see how this kind of snowballs on down. But no matter what, that first $10,000 of income always going to be taxed at 10%. Then same, the next amount's always going to be taxed at 12. So that's where, as you go up, the next dollar gets taxed more and more and more. That's your marginal tax rate. So your effective tax rate is then the average of all that. So say you make $100,000. So all $100,000 is not getting taxed at 24%. So meaning if you make $100,000, you don't owe a $24,000 tax bill. It's going to be the average of these different tax bills. So it may be closer to something like 16, 18% when it's all averaged out. So that's the effective tax rate, is what of your income you actually pay in taxes. So that's just important to know, because every dollar more you make, you're going to want to make sure you kind of control and understand where those tax brackets are coming in, because if you're making more money and not doing anything to protect that money, you might be owing more and more taxes. So that is how the tax brackets in a nutshell work. But sort of diving into this, what are taxes in the first place? So every person has to file an income tax form each year, and that's going to be on the 1040. So this is the form that everyone has to essentially file. And so on here, some of the information the IRS asks for. So the IRS is the Internal Revenue Service. They're the ones that basically determine how much taxes you owe and make sure you're paying those taxes. So you'll put your name, whether you're married, your social security number. So your social security number is your tax identification number. So that's going to be on here, and that's how they're going to link the tax bill to you. You're going to have your address on here, and then also you have things like standard deduction, dependents, so on and so forth. And we're going to kind of go through what this all means. But basically, kind of going back to that marginal tax bracket, where that starts is what is your income, which on line 1 here is what are your wages and salaries, and that you're going to get a W-2 from your work, or if you're a entrepreneur, maybe a contractor, you may have a 1099. Those are going to show what your income sources are. And you may have other income sources such as taxable interest, like this is interest from, say, a bank account or a brokerage account. Money that you make from those type of sources goes in this box. Ordinary dividends, if you own stock and the company pays a dividend, that is also an income source that is taxable. So some may be qualified, some may be ordinary. You would get what's called a 1099B and a 1099 INT for interest. Those two will show these different amounts here. Then you have IRA distributions, pensions. For a lot of people, that may not apply unless you're in retirement. But if you do, those would all go in this area. Same with Social Security benefits. If you bought and sold stock during a year or bought mutual funds, those can incur capital gains. And so let's kind of take a look at what that means. So digging more into just kind of the fundamentals of taxes, you have, skipping ahead, capital gains too as a type of income source. So you have short-term capital gains and long-term capital gains. So you have just your traditional income, but then the way the tax code is written is it's written to benefit capitalism. So it's been, it rewards business owners or investment in businesses. So with that, you have actually a different set of income for investing in companies. So your income rates were those tax rates that I showed you here just a minute ago, which may be as high as 37%. Whereas if you invest in stocks, if you hold it less than 1 year, you're looked at as more of a speculator, not an investor. You're going to still get taxed as income. However, if you actually invest in companies that are holding it for a year plus, or say you own a small business or things like that, you start to get preferential tax treatment. So if you hold, say, a stock for over 1 year, you may have 0, 15%, or 20% on that tax on that money you made instead of, say 37%, just because you held it for 1 year and it was to reward you as being an investor. So that's kind of what capital gains are. It's basically money that you make from investments in stocks, bonds, mutual funds, exchange traded funds, small businesses, you name it. So any capitalistic investments that you make, you have the chance to earn money back on your taxes back just by investing in those type of companies instead of being an employee. So if you have those capital gains, though, those would be recorded on here, and you would get a 1099 for those from your brokerage company, for example. So this is where we get into different. So that covers basically all of the income coming in. However, as a citizen of the United States, you have what are called deductions and you have what are called credits. These are things that whittle down your taxable income to ultimately get to what is called your adjusted gross income or your actual taxable income. So you start out with the raw gross numbers, and then you start to chip away at those. So a common deduction, for example, would be a charitable contribution or a contribution to a retirement savings account like a 401k or an IRA. And how deductions and credits differ is deductions basically lower your taxable income. So, for example, let's use round numbers. Say your income is $100,000. You have a deduction of $20,000. Say you contributed to charity, or you contributed to a retirement account, or have medical expenses, things that are necessarily qualify as a deduction. Then, basically, what happens is you have your income, you have $20,000 deduction, and now for tax purposes, you only have $80,000 worth of income. So if you kind of think back to those original brackets here, so if you had $80,000, basically that'd be at the 22% tax bracket, so $100,000. So you basically save, say 21 or 23% on average on that $20,000. So call it about $4,000 in taxes just through that deduction. So that is how a deduction works, and there's a big list of different types of deductions, depending on whether you're a small business owner or just an employee. So that's kind of way beyond the context of this video, but at least that's what a deduction is. So if you hear that word, that's a deduction basically lowers your adjusted gross income. So credit is a little different. So credit is a dollar for dollar tax savings. So for example, this just lowers your income, so you're paying less taxes on that income. A credit would be a dollar for dollar offset. So meaning if you have $1 owed in taxes and $1 in credit, you now have 0 taxes owed. So there are different credits available out there that can essentially knock out thousands of dollars of your tax bill. So that's where this section is where you have your deductions. Most people are going to file what's called the standard deduction or an itemized, or so well, actually let me backtrack. So you have either a standard deduction or an itemized deduction. Most of Americans are going to do the standard deduction, which every American is given $12,400 this year in terms of deductions that they are allowed to take off for their taxes. So for example, for every American, if you make $100,000 for tax purposes, you now are going to make $100,000 minus that $12,400, which is what $87,600 would be your ultimate taxable income. However, there are, if you say have more deductions than that $12,400, then you can do what's called itemizing, where you can list out specifically what all your line item deductions are, and you could write those off specifically. So, if you own an expensive property and have a lot of mortgage interest, that's a deduction that you can write off. So if those add up to more than $12,400 for an individual, or double that for a married couple, so $24,800 for a married couple, then you can do what's called an itemized deduction. So basically you have your income, then you have your deductions, and then ultimately that chips away and you have your taxable income here. So that ends kind of page 1 of the 1040. Then you get into those credits. So now you have your total tax that you would pay. So you have your taxable income, then you have your tax brackets, which gives you the tax that's owed. And now you can have your different credits that basically just wipe out that tax. And once you get that tax wiped out, then it actually goes and says, here is what you actually owe the government. Or if you say, throughout the year, you're going to have your paycheck and they're going to withhold taxes automatically from that paycheck. Well, what you may find out through this is that they withheld too much tax, and so that's how you get a refund, is because, say you had withheld $20,000 throughout the year, but you only actually owed $15,000. Well, this is going to show that, hey, you paid $20,000 and now you only owe $15,000, and so here's your $5,000 refund. So that in a nutshell is how the taxes work. Is basically it's just you have your income, you have your deductions and credits, which chisel down exactly to where you know exactly how much you're going to owe. And in terms of how you can file your taxes, there's thousands of services out there that can file. So you can either file directly yourself through companies like H&R Block, TurboTax. These type of companies can allow you to just file yourself online. There's even a free version through the government. I think it's I forget, I'm blanking on the name, but like freefile.com or something like that, where you can file directly through the government. Alternatively, if you don't want to, you can basically hire any different tax professionals, which like H&R Block is, tax professional, and also this is a shameless plug for my affiliated tax business, where we can help file taxes for individuals, but you could use a tax service like ours where we can actually file the taxes for you. So basically just take all the work and do it, without you having to do anything. But there's, whether you use us or another service, there are hundreds of thousands of services out there that can file your taxes for you if you don't feel comfortable doing it yourself. But hopefully with this knowledge that you've accumulated from this video, maybe you feel comfortable giving it a dabble for the first time and paying your taxes and just kind of walking through all the different questions. But there are going to be a lot of, for example, if you use an H&R Block or TurboTax, they're going to ask you through a lot of different questions. But ultimately what they're trying to get down to is what's your income? What are your deductions? What are your credits that you're eligible for? And then ultimately, how much tax do you owe? So that's how the entire income tax system works. Hopefully you found this valuable and it was good understanding for the beginners out there that are new to taxes. And if you have any questions, please drop a comment below. Happy to answer any questions that you have. As well, if you found this valuable, give us a like for the YouTube algorithm. Help a brother out. And we appreciate it. But stay tuned for the next video. We look forward to seeing you there. Cheers.